Hello, welcome back guys. We're taking a look at PinDuoDuo in this video. The stock was actually up 10% yesterday with a lot of the Chinese market stocks, and today is actually 8% higher in the pre-market. That's because the company had its earnings report and it looks like it was pretty solid. Now, the 1-year high of the company was $143, which is almost 71% lower from what it is right now, actually higher this one, from what it is right now, which is sitting at $42, and we're expecting it to be near 45 when the market opens. But let's take a look at what happened in the earnings report. Now, they reported the Q1 revenue of 13.7 billion, net income of 410. But how does that compare to the previous years is the question. So in terms of total revenues, the company did 13.7 million here, an increase of 7% actually. Their monthly active users and buyers also increased 4% and 7% respectively here. And operating profit for the quarter was 339 million, compared with an operating loss actually of 4.14, that's one, in the same quarter of 2021. Very interesting. And net income for ordinary shareholders in the quarter was 410 million, compared with a net loss of 2.9 million won in the same quarter of 2021. Very nice to see. It looks like the company is doing significantly better than the previous quarter and of last year. And it makes a ton of sense why it is up right now, 8%. And we'll see, maybe when the market opens it's gonna fly higher, and it may actually affect the rest of the Chinese market. That would be interesting to see in a couple of hours when the market opens. But let's take a look at the financials of the company. Let's see what they are doing in terms of the financials and whether this is a good buy right now is what we want to examine. Now you can see, if you take a look at the max chart here, that the company has been a high flyer, and then with the rest of the stock market pretty much, and especially China, going down again quite a lot, 71%. Is a pretty steep loss here. Now, the P ratio of the company is still high, 51, but the price of free cash flow is sitting at 11.7, and this means there is some sort of a discrepancy here between the earnings, the profit of the company, the net income, and the free cash flow that they generate. We will examine that. Now, the company has also issued a lot of shares, and that's not a nice thing to see, and it's bothersome for an investor, especially if you have been an investor in the previous years. Now, will they continue issuing shares? Probably not, since the stock price has gone down that low. I wouldn't expect them to continue doing so, but you never really know. Now, the 5-year revenue growth of the company has been absolutely tremendous here. Net income growth also tremendous. Free cash flow growth, same thing, and total equity growth. So this is a company that is growing massively, and this is something that you of course like to see. And you can pay a little bit of a premium for that, but not overdo it, of course. Debt to equity ratio that it is rather low, and the total liabilities to free cash flow also rather low, 3.6 years of last year's free cash flow to pay back all the total liabilities that the company has. That's not a lot. And a return on equity of 11%, net income margin of 8.2% is looking fair. So let's take a little bit of a closer look at the financial statements, and I'm especially curious about the cash flow. Now, the revenue here has been increasing tremendously, as you'll see, for the company, from 200 million to 14.7 billion. That's absolutely crazy growth, as you can understand. And you can see here that their net income has been negative and then actually went positive, and it looks like we're continuing at the same trajectory. And the balance sheet of the company, I didn't click that. So we can see here that the total equity of the company has been increasing tremendously as well, 185 million to 11.8 billion. But remember, the company has been issuing tons of shares, and this is the more important reason why this happened, really, this equity being up that much. The cash flow statement now is very interesting because the company has been increasing their net income, and now they're in positive territory. But there is other non-cash items here that are massively increasing the net cash provided by operating activities this year, as you'll see, 3.3 billion here, and a change in working capital as well that happened in 2020. And so we are seeing that, and this is kind of why we're getting this extra free cash flow happening for 2021 and 2020, and it may be worthwhile taking a little bit of a closer look at what kind of change in working capital happened here, or what the other non-cash item was for 2021. Now, as you can understand here, this other non-cash item severely affects the net cash provided by operating activities and, of course, our free cash flow, because this is what generates it minus capital expenditures. And this could potentially be some sort of a write-off, for example, for maybe an acquisition or something of that sort. And they basically, it looks like they are losing some money that is not really cash, and so this kind of loss needs to be added back to the cash flow statement. It's the same thing with stock-based compensation or depreciation amortization, same idea. But it's going to be a one-off thing, and you're not going to be seeing it next year. So you need to bear in mind that we're probably normally sitting at a similar cash provided by operating activities of about 1.2, 1.1 billion. Usually it's going to be similar to this level, maybe a little bit more if you add back the non-cash items. But yeah, we're not sitting at 4.5 normally probably in the next year unless something similar happens. Okay, the cash that the company has, 10.3 billion here. That's a lot of cash. And the free cash flow, again, it's a little bit elevated because of the recent items here. However, this is not going to affect our stock evaluation tool, because our stock evaluation tool is actually working based on the revenue, and it's projecting values starting from the revenue that the company makes, and so these kinds of one-offs don't really affect it. So what we can do is use a revenue growth that's going to be much more conservative. Of course, we want to go much lower than this. We cannot go that high. We'll go something like, still relatively high, because the company is actually getting better and actually getting more revenue. So we're gonna go relatively high and be a little bit, have a little bit of a breadth here. So have a low of 14 and a high of 22, which have some distance here. Now the net income margins, you will notice that they are a little bit over the place, because the company for a long time wasn't making profit. Now they're getting into profitability, and the net income margins are about 8%. So I'm going to go 6, 7, and 8 here. 6, 7, and 8. And the free cash flow margin that I'm gonna use, again, you cannot be very confident about this one because of these one-offs that the company has been generating. But as we already examined, without these one-offs, we're sitting at near 100%. So I think I'm gonna go maybe 80, 90, and 100, maybe a little bit more than 100, but that's okay. 13% for our annual return, and we hit calculate. And we are getting that the current price of the stock is actually more expensive than what we'd like it to be, with our high estimate being at $30 here, based on these projections that we had over here. Of course, if we go higher and we expect the company to grow maybe 25%, 30 and 35, which is not out of the question. This is a company that is growing rapidly, of course. It could happen for the next 5 years, but probably not for the next 10 years. If we do that, then we are marginally inside our high estimates, which would be a 35% revenue growth. But of course, we don't really want to go that much. We don't want to go that aggressive. This is very aggressive. It could happen, but it is aggressive. And so with a current price that's going to be actually at 45 when the market's open, we're going to be a little bit far from what we'd like it to be in terms of our estimates here. And so while this is an interesting opportunity, I feel like in the Chinese market there are better ones right now, cheaper ones, than this one, which is has also been diluting investors quite a lot. Good things to see here. It may be an interesting addition to a portfolio because of the growth. The growth has been tremendous, and so I won't necessarily say that it is definitely a not a buy, this one. But if you decide to buy it here, you have extra risk, that's for sure. That's again because the company is still new in terms of profitability, and we have to go very aggressive with our projections in order to establish estimates that make sense based on what the company is doing financially. A more conservative investor, which I tend to be, wouldn't have much in terms of buying this one at 45 bucks, 46 right now. I would be interested if it was near 35 potentially. That would be much more interesting to me. So yeah, right now it is a little bit expensive, so I would probably avoid it, because again, if I want to enter China, there are better opportunities like Alibaba, for example, which I have talked about many times. And yeah, this one is just not as great right now. It's pretty good, but not as great. Thanks for watching the video. I hope you enjoyed this one. Please remember to leave a like and subscribe. You can also join our Discord channel. There's a link in the description box below, or become a Patreon and get access to this tool. Again, links in the description box below. Thanks for watching this one, and I'll see you soon, guys. Bye bye.